Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I am your host, Juan Vargas. Today on the show, we have Eric Barvin. Eric is the president and CEO of the Barvin Group, where he is responsible for the planning, operations, financial activities, and investment decisions. His real estate background includes the acquisition, renovation, asset management, and disposition of multifamily properties across Texas, valued at over $300 million. He graduated with a degree in economics and international studies from Emory University, where he also played 4 years of basketball. Eric Barvin, welcome to the show.
Thanks so much, Juan. I appreciate you having me today. It's a real honor to be here.
Thank you so much for joining us, and it's a pleasure to have you here on the show. So let's go ahead and get this party started, and tell us a little bit more about your background and tell us where you're calling us from.
So I'm calling from Houston. I'm originally from Houston, and I grew up in the Meyerland area. Like you said, I went to college in Atlanta at Emory University, and then after college, I worked at a company called Capmark Finance that was a mortgage bank financing apartment complexes, mainly apartment complexes, for equity and debt. And that was in 2008. And then in 2009, the company went bankrupt, not because of me at all, but just because of the economy, and I was laid off. And at the time, I had a really difficult time getting my first job at Capmark, but ended up saying, I want to work on my own and do my own projects. And eventually, after a long, hard road, bought my first apartment complex in 2010.
In 2010. So it's pretty safe to say that you bought it at the right time, right? 2010. I mean, that was the bottom of the market. I was pretty much dead bottom around, or at least pretty close to it. So did you have any real estate experience prior to that? Like any personal real estate experience prior to that? Like, did you get into a single family? Did you do any smaller multifamily, or anything like that?
Aside from my work at Capmark, I did not have any other investments prior to this. I looked at a lot of projects, and the one common denominator that we still have today is we like cash flow. And so we were always looking for cash on cash returns. And the first project I didn't even think would happen. I mean, I didn't have any money. I didn't have any resources at all. And so I was kind of out there just making offers. And I was fortunate to be at the right place at the right time. And there was a project that was foreclosed on in Baytown, Texas. And I toured it. The loan amount for the project, it was 158 units. The loan amount was $3.6 million. The Wells Fargo foreclosed, and the ask price was $2.5 million. When I went to the property for the tour, I observed the broker talking about how he was not happy having to drive to Baytown, and he didn't like dealing with this property and just wished it would sell. And it was a rougher part of Baytown. At the time, Baytown had a pretty rough reputation. It was about 50% occupancy. And I realized, just looking at the property, that it wasn't not in terrible condition. It had been painted, the roofs had been replaced. It needed some, maybe a few $100,000 in deferred maintenance. And so I actually offered, they were asking $2.5 million, which is very little for 158 units. And I offered $1.35 million. And anyway, they said that someone else was going to buy it. And this has been the story for my entire career. Most of the properties we ended up purchasing is that someone else came in at a higher price. They couldn't get financing. And we did not even though I didn't have any money or any track record, I still didn't have any financing contingency, because I knew if I got it at the right price, I could get the deal done and raise the money. And after about a month or so, maybe a month and a half, they called me back and they said, "Hey, Eric, Wells Fargo doesn't want to waste their time with these other guys. They'll take your offer at $1.35 million. And I said, well, it's been a while. The new price is $1.2 million, which was $7,600 a unit.
Wow. Wow, that's awesome.
So,
yeah.
So anyway, that was my first deal. And I still didn't have any money, even if I got word of the deal. And so I had to go and raise money and get a loan, and all that stuff is very difficult to do, especially in that economy. So I was able to pull it off, and it turned out to be a great investment.
Wow. I love that. I mean, that's just an awesome story right there. So you were able to get it. We said it was 158 units. Is that correct?
Correct. 158 units.
158 units, and you pretty much got it for 1.2 million. I mean, I don't know what the math from the top of my head, but man, I know that's an insane number to be able to get a property that size for that amount. You know, obviously it has some hair on it. You know, it was 50% occupied, and you know it was in a little bit rougher part of town at that time. But that was a good first start. So, you know, what made you feel like, you know, hey, you know, I can go do this. I can do this on my own and go out there. And, well, not necessarily on your own, but like with the team of guys, right? I can go out there and lead this acquisition. What made you decide that you were able to do that?
When I started, I was on my own. I didn't have anybody working with me. And I think I was kind of in a corner when I started. So I had a very difficult time getting a job after college. Even though I had good grades and played sports, I came back to Houston and I realized that it was a very relationship-driven business. It was not it was also the economy was not doing well. And so it was very difficult for me to get jobs. And then while I was looking for my first job, my father was unfortunately laid off from his job where he'd worked for a long time. And then I finally got my job, which was a very low-paying job, and I was laid off after 9 months as well. And so I was kind of in a situation where I had seen with my dad and with myself, I was like, wow, like I really don't want to put my faith in someone else. You know, I want to put my faith in myself. And so that's what kind of just gave me the courage to do it. And it wasn't like I just woke up one day and bought apartment complexes. It took me about a year before I closed on my first project of networking and building relationships and learning about markets and brokers and lenders and whatnot.
Got it. That's beautiful. So is that a property that you still own today? Is that correct?
I unfortunately do not still own that.
Oh,
I
had
to sell some stuff to get money to keep growing. So I had to sell that one. I believe I actually have sold 2 or 3 times since I purchased it, which is good for me. I don't ever want to sell a property to someone and lose money. So
right.
I'm happy that someone else has made money on it as well.
So you got it just for, I did the math here. You got it for just over, $7,000. That's what it looks like, $7,000 a unit. So what was it traded for whenever you exited out of that property?
I don't know if they're going to want me to say it. I guess they've sold it by now, so it doesn't really matter. But so I sold it for about $35,000 a unit.
Okay. And this is how long ago?
I sold in 2013.
2013, which even at that time was still, you would think, 35 a door, it's a lot during that time. But if you look at it now, the way things are, I mean, if you're buying it for 35 a door, I mean, you're still making a killing, So, yeah, I love that.
Someone told me that it's selling now, or it sold recently for, I think, in the 70s a unit, which is insane. But that's just the world we live in. The two things that I'll tell people, I think that the more important, the show hopefully is not about me making money. It's more about how you can kind of learn and what to look out for. And when I looked at that property, there were a few things that I saw that made me confident in my offer. The first was that even though it was low occupancy, it was 100% occupied on what was livable. And so there was nothing even though it was 50% occupancy, the other 50% of the property was down. And so I was confident. I was confident that if I brought the units online, they would lease, because the rest of the property was 100% occupied on what was livable. The second thing is that Wells Fargo is a major institution, and it was a small balance loan. And so I knew that it wouldn't be that important to them. They were working on bigger projects, had bigger things. It takes the same amount of time for them to work on this $3 million loan as it does to work on a $30 million loan. So they were going to be less concerned of maximizing the value of the loan. Like I mentioned earlier, the broker I knew was not happy with all the tours, and they just wanted to be done with it as well. And the trick that it was a great buy, and I was the right place at the right time. But the way that I was able to raise the money was I went to a bank, and I had a friend who was early banker. It was his first or second year at Frost Bank, and they could give up to a $1 million loan without loan committee, which was really nice. And so he ended up somehow getting me a loan for $950,000. And when it appraised for double what I was paying for it. Nice. And so took that appraisal to people that I thought had money, and that's how I raised the $500,000 that I needed for the investment. And so that's kind of how I started my business.
Beautiful, beautiful. I love it. So, for the investors that you approached, it was like kind of like a no-brainer for them to proceed in this deal because it was being appraised for a much higher amount than what you were acquiring it for. So, yes, I
Yeah.
love that. So, let's kind of fast forward to today now. What kind of properties are you looking at today, and what markets are you specifically targeting?
We're typically B and C buyers in the major Texas markets. Right now, our portfolio is Houston, Dallas, and San Antonio. And we focus on traditionally well-located properties that are a little bit older that cash flow. That's our main business model, and that's what we're looking for.
Got it. So when you say a little bit older and you say B and C type properties, is there a certain type or a certain year construction that you don't want to go past? Is there a certain unit size that you don't want to go, that you're not going to consider? Let's say, if it's 100 units and lower, you're not going to consider that? Or what are your main criteria as far as, this is a deal that I'll look further into?
So we would most likely not buy a property that was under 100 units. It'd have to be 100 units. We can do big properties or portfolios, so we can go up pretty big. And then in terms of age, we're pretty flexible. We really have three buckets of kind of activity. Value add, which is typically properties built before 1995. We go in and upgrade. Stabilized, which is newer properties, and development. And so we've been most active on the value add side, but we're trying continually make offers on stabilized properties and development opportunities. We just have not found anything that works yet.
Okay, it's something will come up, so that's the thing. If as long as you're in it, and something will definitely come up. So you mentioned that you do San Antonio, Houston, and Dallas. Obviously we know all the benefits. We don't talk about the benefits of these markets because they're well-known, big, type markets. Are you looking past these markets? Are you looking at secondary, tertiary type markets? And are you looking at other states as opposed to apart from just Texas alone?
So we only focus on the major markets. We don't do tertiary markets. Even in the markets, we tend to do more infill locations. We believe in the demographics, and we have a few important demographics like household growth and bachelor's degrees and income, but we really focus also on the spread between the cost to buy a home and the cost to rent an apartment, and that's a big thing for us. And so we tend to look in locations where it's very expensive to own a home.
Okay, so can you go into a little more detail on that? You mentioned that you look at the cost on buying a home versus renting. What exactly are you looking for whenever you're looking at a property or looking at a different certain market and demographics?
Yeah, so we look at inefficiencies in the subsection of apartments, right? So we have information on all the submarkets in, let's just say, Houston. And we'll go through each submarket and we'll look at inventory. So how many units are in the submarket versus how many people and renters there are in the submarket. We'll look at how is that inventory dispersed. So were the properties built in the 70s, the 80s, the 90s, the 2000s. In certain submarkets, just in Houston as an example, there's properties that were not built in the 80s or 90s at all. So the rents for the 70s product are, let's just say, back when I started, they were $700. Today, they've probably become $900, $950. And then the Class A is $1,400 or $1,500. And so we try to find those inefficiencies. And then we also look at what's it cost to buy a home. So, as an example, homes sell for $700,000 in submarket. Well, we feel pretty good because the apartments, per unit are $60,000 or $70,000 a unit. And in addition, we're really big on, household income, like I said, growth, population growth, bachelor's degrees. We have a whole metric list. I don't have it in front of me, unfortunately.
No, it's okay. It's okay. So as far as income, what are you looking for there? What is your minimum income before you were able to proceed in the market?
Uh, I think about for household income, you mean?
Yeah.
Household income, at least $50,000.
Okay. So $50,000 in a certain type of submarket, you're gonna have the Starbucks, Home Depots, the Lowe's, Walmarts, those type of big companies surrounding that property. So yeah, I mean, there's going to be jobs, good jobs there. So that that's what you want to look for. The other thing that you mentioned earlier was, if you're looking at a certain submarket and you see there's product there from the 1970s, and then there's no 80s and no 90s, and then it goes to 2000s or 2010s, right? So is that a market that you would rather go into, or you would rather not go into?
So on the income side, we're flexible. So like the store, we are opportunists, and so we will, wherever the opportunity is, we want to go. If there's a heavily distressed deal that we think we can create value in, we will go there. Or if there's some situation and it's a brand new project, we will go there. In terms of that scenario you're talking about with the 70s, the lack of 80s and 90s construction, that's exactly what we want, right? Because we believe that there is demand for B product. It depends on the location, obviously, but there's innate demand for B living, right? And so if you're only being provided A living or C living, then you can buy the C, fix it up, and create the B. And so that's been our model, and we've done that a lot.
Got it. So then you're able to fill that need, like you mentioned, and go in there and upgrade that property, provide the amenities that some of these A-type properties have, and then it makes it much more attractive for the potential tenant to live there, and at a pretty good lower rate, right, in rent. So and then you're able to fill them up pretty quickly. So yeah, I love that. It makes sense. Makes a lot of sense. So what as you grow larger, you're obviously, in the past, whenever you acquire your first property, you had a source of capital. What do you do during a downturn for your capital sources, both on the debt side and your equity side? Obviously, whenever things are going great, everybody is willing to lend as long as, the property makes sense, the business plan makes sense, the guys that are acquiring the property have had a good track record. So whenever things change and we have the market changes and now we're in a down cycle, how do you stay in front of those lenders, and how do you allow them, or how are they staying in front of you as well to want to give you a loan?
So we've worked really hard to have a diverse group of lenders. We work with local banks, Fannie Mae, Freddie Mac, and life insurance companies as well. And the hope is that when the market turns, that the properties that we own, we can still cover the debt service. And because we're very transparent and do a good job and own properties that cover debt service, we hope that they will continue to lend to us in a downturn. We recently ran a debt service coverage analysis on our portfolio, and we have over 2.05x debt service coverage on our debt, which is very high for
Yes.
for what we do. And so we feel pretty strongly that we're prepared for a downturn, and any shakeup, and that we would come out stronger than we went in.
Yes, that's exactly what. That's how you prepare yourself. For the long term, is not over leveraging too much. So you mentioned earlier we were talking about what markets that you like going into, and obviously, like I said, earlier, the Houstons, the Dallases, and the San Antonios. And you mentioned that you don't like secondary, tertiary markets as much, right? That's not necessarily what you focus on. What about out of state? Are you looking out of state, and if so, or if not, then why not?
We're only looking at Texas. Our goal is to create scale within our organization, and through a slow kind of organic manner grow to have 15 or 20,000 units and get scale in each of these markets that we're in. And so our main primary focus is to do that, and hopefully we can find opportunities in those markets that we know, and we want to be best in class in what we do, and we feel like we have some sort of competitive advantage and local knowledge in those markets, and so that's where we want to take advantage of.
Got it. That makes sense. So how are you structuring your deals with your investors? What is it? What is your split? What is your typical split? You don't have to go into detail on a specific property, but what is your overall typical split? Are you doing a 70-30 or doing 80-20, or is there a preferred return? What does that look like for you?
So typically I invest between 5 and 10% of the required equity, which is, I don't think it's super normal. I'm one of the largest investors in each deal, which gives comfort to the other limited investors. And then we have typically between a 6 and an 8% preferred return. And then once investors have received their money back, we get a 35% promote.
Yes. Okay. And that has worked well for you. Why is it that you decide to put in, I mean, like you said, that's not, I mean, I wouldn't say it's not normal, but it's not as common as that I've come across. Why do you feel like you're comfortable putting in 5 to 10%? Which obviously, at the end of the day, you want to put in some equity as well. You're aligning the interest with your investors as well. You both have skin in the game. But why are you putting up to 10%?
So I think you see a lot of people who say that they put in that amount and they're actually getting the money from somebody else. They're kind of raising that money on the side, and they have their own, friends and family fund that contributes to co-invest for them. I do it myself because, I'm really invested in the deals and I really believe in what we do. And it's made it easier for me to raise money. And so when I started, I had, very little connections and very little resources. And so the way that I raised money was by meeting people and telling them how much I was investing. And they're like, oh, he's 26 or 27 years old and he's investing that much money. Yeah, I'll put in, $100,000, sure. And so it kind of gave them comfort. And as we've grown, we've had success, and I've been able to continue doing it. So I've been very fortunate.
I love that. Yeah, you definitely want to be able to align yourself with your investors. If you're putting in capital, that definitely is going to help and is going to make it easier for you to be able to raise the capital. So I love that. That's a great answer. So how are you connecting with brokers? These deals they're not going to just fall into your lap. What do you do? What is your strategy when talking to brokers, connecting with them? Can you give us some pointers on that?
I think be truthful, is the best thing you can do. Really don't overpromise. Perform is the biggest thing. I think we're at a point now. I purchased about 4,000 units. I still own 3,500 units, purchased 13 properties. I still own 11. And of the 13, 8 were projects that had fallen out of contract that came back to us. To be transparent for brokers, I think the best thing to do is to be transparent and be honest with them. I don't think brokers like when you say that you're going to do something and then you end up not being able to do it. So we've been very transparent and try to build a reputation that we can close on deals. And that's how we bought a lot of properties. Of the 13 properties we purchased, of the 13 properties we purchased, 8 had fallen out of contract, been under contract with someone else, fallen out of contract, and we got a second chance at them. And that's because of relationships and doing what we're going to say. Because at the end of the day, all the broker wants is they want to get a commission. And so if the deal closes, they get their commission. If the deal doesn't close, they don't get their commission. We've got great relationships with almost all of the brokers in the markets that we're in. So very thankful. But it comes from doing what you say you're going to do.
So pretty much be a man of your word. And, if you can't perform, if you can't do something, then don't even try to do it. Then, you got to be confident in performing, and closing on the deals. Like you said, if you're not closing on the deal, then they're not going to get paid, and that's what they work so hard for, and they work so hard to build those relationships with those sellers. And so they don't want to be wasting their time. So that's a great answer, and a great appreciate that you were able to share that. So yeah, let's kind of talk about what has been your biggest failure since you started your investing career. which property or what situation was your biggest failure, and what did you learn from that?
So my biggest failure. So I'm thankful that all of the properties we purchased make money. We've sold them for profits or they make distributions. The two things that I think I would advise people on. We bought a property that was vacant one time. It ended up being a great investment, but we underestimated what the renovation would entail, and we bought it for about $8,000 a unit, and we thought that we'd be in it for about $25,000 a unit, so 15, 16 door renovation, and it ended up costing about $30,000 a unit to renovate. And so that was I didn't have the money to finish the project. I was kind of didn't want to go back to my investors because it wasn't their fault, it was my fault. And what I did was I ended up covering the difference. So we were, I believe, about $4 million short, $4 or $5 million short. And I had one investor who was willing to give us a second mortgage at the same rate as our first mortgage for $2 million. And then I covered the balance. And I didn't make any interest on my money. I got paid back. So it wasn't like I contributed to the partnership, never got paid back. But I didn't make any interest. And I think it built a lot of trust with my investors, seeing how I handled that situation. At the end of the day, it was a great investment. And it's worth a lot more than we're in it for, thank God. The second thing to look out for, I think, is just competition. So we purchased two properties actually in 2015 that fell out of contract, and we got them for about 15 to 20% less than they were under contract for, so we felt pretty good about it. But we didn't pay enough attention to the properties that were under construction in that submarket. And the properties will be fine. They're great locations. They're long-term investments. We still make money, but it's definitely something that kind of woke us up in terms of these other markets that we're in and just watching out for new supply.
Got it. Yeah, those are some great points as well. So, and what has been your biggest accomplishment since you were able to start your company? What do you see that has been your biggest win?
From a big picture perspective, we've raised about $90 million when buying these properties of equity, and we've returned over $33 million. And most of that's come from cash flow. So we've been able to provide distributions to our investors and still have them have ownership in the properties and still maintain and have value appreciation. So I think that's been, on a big picture, a big win for us. In terms of transactions, I was relatively small and kind of, not that I'm not a big time person at all, but definitely a smaller person. I had done 5 transactions from 2010 to 2013, and the largest equity raise I'd ever done was $3 million. And I purchased a property in 2013, at the end of 2013, called Park & Boss, which is 810 units. It was a $17 million equity raise. So that was a big thing for me. And I think that getting to that next level in terms of just deal size and investors was very good for my career.
Got it. Yes, and it's something that's it's a gradual step. And obviously you're not gonna be able to raise $17 million on your first deal, and if you can, then then you're one of a very few that's able to do that. But now that we're on that subject of investors and the equity side, why don't you tell us a little bit about how you are able to approach your investors, and where do you find these investors? Where how do you get these guys to kind of jump on your business plan? And obviously we all know that they're investing in you. They're they look at the project, they look at the returns, but first and foremost they're looking at you, right? So how do you get guys, and where do you get them? First of all, how do you get them to kind of join join forces and invest with you?
So I meet with investors through other existing investors, and that's how I've done it the whole time. I haven't worked to actively market myself to investors or
I'm not on YouTube talking about you should invest in my projects. We've been fortunate to have a lot of satisfied investors who are happy with us, and they introduce us to other people. That's been the main way we do it. I would say that one of the reasons people invest with us is because of my co-invest. They feel confident, and now also they feel like we can execute. So we've done it multiple times, and it's not just saying, "Oh, Eric can invest. You should invest in Eric Steele." It's, "Oh, he's actually done it and performed well." The other thing I think that differentiates us from some people, and this is for people also who are looking to invest in sponsors deals, is the fee structure. So we're relatively light on the fees compared to other operators. In turn, our promote's a little higher on the back end, but I think that's always how you want to invest alongside people, is with lower fees on the front end. So that's just something I think that people like. And I mean, I remember I have a friend who helps with private REITs, and private REITs raise a lot of money through broker dealers. And he told me that for every dollar someone invests through a broker dealer, 82 cents actually gets into that deal. And that's a lot of fee. And so we did the math, and so it's like 99.2 cents or something in our project. Like most of your money gets in, to the deal. And so I think that they just see the value in that. And we're trying to always get new investors. Obviously have to be accredited, but we're always trying to expand our network. And right now I have about 170 investors, and I'm trying to grow that, organically.
Yes, I love that, how you have been able to grow that organically, and the best way to do that is to perform, kind of like when you're acquiring a property through a broker. The best way is to perform, be open and transparent and honest, and have good communication with your investors. And then obviously, whenever you exit, upon exit of these properties, and they're able to see the returns on the back end, then that's even that's the icing on the cake. They're able to tell other guys, they're able to tell their friends, because everybody wants a piece of a good return, right? So I love how you have been able to build that organically. So thank you so much for sharing that. So yeah, Eric, I think it's time for our nuggets of wealth. These are questions that I ask every guest every week that hopefully are able to help our audience out, in one form or another. So what is a key tip or advice that you would give to others who are looking to take their business to the next level?
Patience. Patience is the most important thing in investing. Don't feel the need that you have to do something. Be willing to walk away from deals if they don't work for you, and have a investment criteria that you stand by. And if it doesn't fit your box, don't do the deal.
Okay. I really like that, because I think there's a lot of us tend to get a little impatient. First of all, we see a lot of the guys doing deals, and we kind of want to buy our deal on our own, and sometimes it doesn't happen that way. And so it can be a little frustrating. It can be a little depressing, I guess you could say, for some of the guys. But the key thing there is to stay patient, and to also have a strict criteria. Don't go around and chase deals, or so you think that they're going to be deals. Just have a strict criteria. What is a good tool, source, or platform that you use frequently that can also help others?
So we use for market research, we like to use Yardi Matrix. They get a free shout out. Maybe they'll give me a discount. and then we also use, for project management, a tool called Asana, ASANA.
Okay.
And that's like a to-do list checking application. It's very helpful for our construction division, due diligence, a lot of different things.
Got it. So use Yardi Matrix and Asana. I've had some people recommend those tools, and they have been pretty helpful for a lot of people out there. So, what book are you currently reading?
I just finished a book called On Leadership Development by Ken Blanchard. Finished yesterday, and it talks about being a leader, and how to motivate your team, and how to make sure that your team each person on your team is being maximizing and feeling meaning in their role. And so that's something that, as you grow, I think is really important. I think there's different books for different times in your career. At our stage, that's a really important thing. But for people who are just starting out, one of the books that I recommended is called The Real Estate Game. I've read it many times, and when I first started, it's written by, I think, a Harvard professor, and does a great job of explaining how real estate should work and the nuts and bolts. I really enjoyed that. And then, yeah.
Okay. So you said The Real Estate Game, and what was the first one? Who was the author of the first one?
Oh, put me on the spot. Ken Blanchard.
Ken Blanchard.
Yeah.
Okay. Yeah, it's okay. You know, so we can always look that up. We can look them up, and then we can add that to the show notes for sure. So where do you see your business and company in the next 10 years?
So hopefully we've been able to scale our business and have scale in these other markets throughout Texas, as well as have a management company. My personal goal is to have what's called a self-managing company. So to bring in a CEO or a president to run the operations. I have a COO, but to run the acquisition development projects for our company. And that'll put me more in a raising money role. But my goal is to kind of, at the end of the next 10 years, to be out of the day-to-day operations. Not that I don't want to be involved, but I want to create a generational company. And I think that sometimes when the patriarch is in the role for a long time, that it can make the organization dependent on that person. And so my goal is to create an organization that's not necessarily dependent on me.
Yes. So to add to that, I guess you can say that if you're involved, in the day-to-day operations for the long term, then sometimes it can tend to get a little stagnant. But if you're able to hire a lot of key players, then it can also boost your company, your productivity, and ultimately revenue for not only for the company but also for your investors, because they're your customers ultimately, right? So, yeah, I love that.
Well, your in the apartment business, your customer is the renter.
Yeah. Well, yeah, I guess you could say that. Yeah, the tenant himself is the actual customer. Your investors, in a way, they are they're ultimately partners. But you got to have good communication with them,
Sure.
and do those kind of things. So yeah, I like that as well. So at the end of your life, Eric, how do you want to be remembered?
My goal is to really create a legacy for my family that they'll be proud of, and to have to make the world a better place, and the residents who live at our properties, a better place. We focus on their lifestyles and trying to do what we can to improve their day-to-day lifestyles, and hope that positive energy reflects on their actions with their friends as well.
Got it. Great answer. Yes, sir. I love that. So where can Commit to Wealth Nation go to contact you and find out more about you and your company, the Barvin Group?
The best place is our website, barvingroup.com, and there should be a contact page or email on there for you to reach out to us. We're always looking for deals. We're always looking for investors. We're always looking to meet good people. So happy to talk to anybody.
Okay. So you said through your website. Okay. Well, then we'll make sure to put that in the show notes as well. So thank you so much, Eric, for the value that you have provided for myself and for my audience. I appreciate that very much. Thank you so much for your time, and I wish you continued success.
Thank you, Juan. Same to you. I appreciate the time. Take care.
Yes, sir. Thank you very much.